Welcome back to the Mike Rosehart Show. We're live again for another episode, and today I'm just hanging out in the foyer of the house, and we're talking about inflation. So inflation is something that's a little bit scary, I think, for a lot of us investors right now who are hanging on, waiting for that moment when we're going to be able to say, hey, rates are going to come back down. Our investments can flourish. The cost of debt's going to come down, which is going to be great, and just overall increase our yields. So I'm super excited for that moment, but I don't think it's coming quite yet. So today we're going to talk about, obviously, if you have any questions, put them down below. This is a live Q&A, so whatever you guys want to talk about, of course, we can talk about it. But I think my thing's frozen. Either my phone's frozen or the internet's frozen. Guess we'll find out here in a sec. Let me know, by the way, in the bottom of the comments if you guys can hear me. Hopefully you can. My timer is frozen and it's 0 people here, so I don't know. Smash that like button if people are here, because for some reason my people counter is off. But anyway, we'll keep going. I'm sure people are there. I don't know why it's not showing up, but okay. Today, Bank of Canada did not raise rates, which was expected. They held rates steady, so no more increases for right now. The Fed on the US side is likely going to do another increase soon. I see people doing the thumbs up icon, so the chat's popping up now. Okay, there we go, we're live. Sometimes when we go live, and I guess I'm kind of far from the Wi-Fi box, things can happen, it can be crazy. This is one of the Airbnb projects we just are finishing here. It's our 5th project here in Florida, so this one turned out really nice. I would love to do a tour for you guys at some point, but it's a beautiful foyer when you walk in. It's not really obviously set up right now for a house tour, but I could go around and give you the whole tour. It's a beautiful big wood table here we found on Amazon for $200, which is a score, and we scored all along the way. Like, I got free furniture and couches and stuff off Marketplace. It was a really affordable furnishing, but we did spend quite a bit renovating the property, and it really does show now. It looks really nice, and we've increased the value probably about, I don't know, $80,000 on this one project here, and we got a couple other ones going. So that's what I've been up to here in Florida, and I'm heading back to Canada soon. Within probably this weekend, I'll be heading back to Canada. It's warm. It's actually colder in Florida right now than back in Ontario where I am. So we've had a really warm streak in Ontario, and here in Florida, the last 3 days it's just been raining every day, which is the worst, mostly because of my bad luck. And we're putting a brand new roof on the other property a couple of blocks over, and they took the whole roof off, and then we just got rain every day. And it's like, we need dry days to put the new metal roof on. So that's been a bit of a bummer, but we're making it through, guys, making it through. Okay, so inflation, I want to talk about inflation. So why do I think that inflation, though it's trending, we got our data today, they were expecting 5.1% inflation. They got 5% on the 1 year, which means inflation's still high. That's how they're measuring it. They've been changing the equation. They changed it again in January. So it's one of those things where, it's a bit of a lie in how they present that data. But let's just pretend, and by the way, if you take the equation they used in the 1980s and 1990s on how they calculated inflation, you calculate the same basket the way that they did then, inflation's double digit. So anyway, we'll just leave that there for a second. There are reasons why they changed it, and it is what it is, but I will say that I think inflation is actually higher. But it's interesting because now a lot of the real estate investors that I follow, and the guys who are pumping up on borrowing debt, they're like, hey, rates are not going any higher, inflation's coming down, we're all going back to normal. The same people who a year ago, even more than a year and a half ago, were like, hey, rates are gonna come up, but they're gonna come right back down, guys. And by 2023, everything's back to normal. I'm still thinking it's gonna be into 2024 before we have anything settled. And it may go longer, because if they cut too early, if they don't keep hiking, the pain resulting from, well, one, OPEC bringing oil to $85 a barrel is going to have big impacts on the cost of transportation, the cost that contractors are charging. Gas is everything. Transportation is super important. Even to get labor, to and from places, and materials to and from places, that's really heavily reliant on the price of oil. So that will affect things. Not now, because we had low oil on the day that we're looking at now. In a few months, we will start seeing the effects of those price increases. And then there are other things, like in Ontario, as an example, and even in Canada, our minimum wage is going to $16.55 an hour. Federal's already happened, and provincially in Ontario, they're going to $16.55 an hour. When you take minimum wage to $16.55 an hour, you don't think that the renting class, which are floating around that income level, they're going to get a 10 or 15% boost, and then take that money and directly bid for we have a housing shortage, right? So directly bid for more for rent. Of course they're going to. So we're going to get rent inflation. And we're going to get, they go to Subway and they go to McDonald's. So they're going to get inflation there too, right? So there'll be areas where we will get inflation directly related to these wages increasing. And so as people have more money to spend, it doesn't help our problem. But the real elephant in the room, the real problem that's existing is basically what happened with this banking crisis and how the Fed is bailing out. The FDIC is bailing out these banks. And they've printed back 2/3 of the quantitative tightening that they had done. So they're reversing a lot of the effects. So if they cut rates, they won't. Rates are not coming down in the May meeting. I know people are saying I think at one point it was an 80% probability of no hike. Now it's like 50-50 or something. You can look up what the probabilities are. The markets try to price it in. What we know is that bond markets are horrible at predicting the future, especially in the last 18 months. They've been extremely wrong. If you're a bond investor in 2022, you got wiped out. Like, you're going for a 3% yield, in some cases lost 10 or 15%. So you've lost the next 5 or 10 years of growth holding useless treasury bills at very low yields that got destroyed as, obviously as the rates went higher. If you have old, bonds or debt products, they're now worth a lot less. And to get rid of those today, get them for cash, you can't even sell them for $1 at face value. You have to sell them for a loss because, again, anyone can go out and buy those 8% yielding coupon stuff. So why would they buy your 3%? Well, you have to now give them a 5% discount. If it's a 5-year product, you give them a 25% discount, 5% times 5 years. So it was crazy for a while. Yields are floating down a little bit right now. Bond market seems to think Fed's going to pivot. How will they pivot? When will they pivot? I don't know. I don't think it's coming quite yet. It could. I hope it does, by the way, because again, I benefit. Real estate's going to rip when I say rip, not going to go down anymore. I think we're going to have more of a slow curve. I don't think we're going to see the kind of appreciation we saw. The last 10 years was some of the best years for investing in real estate ever. The last 5, let's call it. Last 5 years, double-digit appreciation every single year. That's not sustainable, and we can't plan to have that going into the future. It's just not something that's going to continue to happen forever and ever. So when you run your numbers, definitely do not rely on that. That is not a key. Really, it's not smart at all. So that's my thoughts on that. Okay, Q&A here. Looks and sounds fine. Oh, perfect. Awesome. Port City says, back-to-back, no rate hikes. Multiple offers on property still in my market. We are doomed. Hope all is well, Mike. So it depends on the local market that you're in, right? Every market is a little bit different. But by and large, what we're seeing is the spring heat. Every year, mostly it's driven by families. Families have kids in school and they don't want to move when the kids are in school. So they look for a house, they put their house up for sale in May, hoping it'll close in June, and then they can look for a new house in that time and move in the summer before school starts in August, September. So what we see is a huge influx. And another reason for that is that in the spring, especially in countries or cities where there are, conditional changes, where, as an example, in the spring, the flowers come out nice and the grass is green. Whereas in the summer, like late summer, grass is dying. In the winter, everything's dead and gloomy and there's snow and people just don't want to go out because it's like Christmas and holidays. So the best time to buy is when people don't want to come out. So you want to list your house, you want to sell your properties in the spring, and you want to buy in the dead of the summer, or preferably, the data suggests, in your November, December, January. Specifically, January has the best data, but it's led primarily by December, data being quite lagged in some respects. So you can use those December comps to then drive things a little bit further down in January. But if you look seasonally, in the last 25 years in the data, and I argued with realtors about this and actually had to bring out data before and be like, you're wrong. They're like, there's no price variance between selling in the spring and, in the fall or in the winter. And it's like, yes, there 100% is. Go pull up an average price chart. In almost every given year, even crazy appreciation years, there's an adjustment drop for December, January. So you can look at the data. It's proven, clean as day. If you can, try to sell in the spring. Don't get caught up in buying in the spring fever, but if you see a great deal, snipe it up. The nice thing about the spring is that most people list then. So you see the number of listings jump. You'll go from having a couple hundred listings to thousands of listings popping up all in the spring. So what that means is, in a lot of craziness, there are some really great deals that otherwise aren't going to pop up in the December time period because there aren't as many listings then. So there's just so much more volume. There can be great deals in the spring, but on average, you're going to overpay. on average in December, January, you're going to get a discount of 5 to 9% in a given year. In a bad winter versus a really hot, good spring, you're going to see a 10% variance in the price of real estate. So just know that fact. That's a seasonal trend that has held the test of time in most markets that go seasonally from cold to hot and hot to cold. So just keep that in mind, guys. That's my thought. You guys come here to hear what I think about real estate prices. I think that, I buy all year round, right? I run a business in real estate. So I can forecast where the price is going to be, but I have a margin of error. So if the market goes down 5 or 10%, no big deal, because I'm not buying at market and hoping for appreciation. That's a bonus. That will happen over a long period of time, but I'm trying to buy at a discount now so that day one I can make something. I want to make a return on my money day one, and then I want to make money on cash flow, right? We buy so that we can hold. And when we hold, we make money every month, and that's the business that we're in. That's the business you should be in, investing in real estate. You shouldn't be speculating on, some random development land play that won't pay out for 7 years, where you're dumping money in and praying that the city's going to bless your permit for approval. That type of real estate investing, though, can be fruitful, is not a great way, I think, to build your base hits, to build your financial independence war chest. I think it's much more predictable and stable and likely to succeed where you just do base hits and you buy properties that produce cash flow, you unlock the value of that, you want to buy another property, and you build a small empire. And then when you have a huge empire of cash flow and you can afford to carry a property that loses money for 7 years until a big payout at the end on a big development, okay, I can see where speculating or having a portion of your portfolio in that space can make sense, to have some exposure to that. But the average investor watching this who's got, under 10, 20 properties, you probably shouldn't be looking at development as your first couple of plays. It's definitely a more advanced strategy and has a lot more risk. Okay, next question. Port City, just to sort of close out that question. You're not doomed. It's okay. Depending on your market, you've probably seen quite a bit of pullback already, which is fantastic. Rates will fall eventually. I don't know how low they're going to fall. I don't think we'll ever see, well, not in the next 2 years, I don't think we're going to see rates like we saw. I don't think the 1.24% Canadian 5-year mortgage is going to come back again. That was what some people were getting. I heard some CMHC deals where it was 0.98%, less than 1% interest. You won't see that again, I don't think, anytime soon. But we could see 3%, 4% in 2024, 2025, which would, I think it's more likely we see inflation kind of look like this, right? It'll downtrend, but it's not going to downtrend perfectly straight. So there will be opportunities, I think, where things never move as fast as we like. People never break down as quick as we think. Raising rates really high like this, to force inflation down, you need to beat down people's ability to their staying power. Like how long till they can default. And you'd be surprised how resilient people are and how long they will go until they stop spending. And they will max their credit cards out first. They won't default on their mortgage right away. They'll find ways to borrow from Peter to pay Paul, et cetera, so forth. So it really is one of those things where it takes time. And it takes longer than most analysts, I think even the Fed thought, to bring inflation back down. And a real challenge is that we're not going to get any deflation. Like the last 3 years, we've had wild real inflation. Even the inflation by their metrics of calculation is high. Like 5% inflation is not great on 1 year. And there are certain segments that are much higher. But 5% isn't even good. They're targeting 2%, right? So inflation is currently like more than double where they want it to be. And it's still running like that month over month, right? Remember that. We're still getting that crazy inflation on the yearly basis that we shouldn't have. We should have deflation to bring things back into reality. When you have a spike of inflation like that, where you inflate things in double digits, you need to bring that back down. I think deflation is the right path probably, but I know governments like to, they like inflation. It grows the tax revenue bill. It takes the assets from the wealthy. It obviously allows them to print their way out of the debt that they have. They have huge deficits. And it's much easier. It's very hard to go to people and say, hey, we're going to raise the tax rates, though the Democrats are good at doing that and the Liberals are good at doing that in Canada and the United States. But it's easier to just leave tax rates the same and then inflate it so your dollar buying power is less and they can just take. So if you had a $100,000 property, they inflate it 10%. Over time, it'll be worth $120,000. They'll take that $20,000 capital gain. They'll take 40% of that. So they get to increase it so that they can then take from you without even changing the tax rates. They can just take some of this newly inflated wealth, which is why debt is so important, guys. Talk about debt being really, really important. The cornerstone of how I've built my business and how you need to build your business around real estate and just all of your assets when it comes to, talking about leverage, how do you apply debt to good quality assets? You've got to be trying to find assets that generate more than the cost of the debt, and then applying debt to that asset. Because if you have a $100,000 property and you put $20,000 in, and the banks put in $80,000 at a fixed rate of return, and inflation runs such that the return yield on the property is higher than the cost of debt, you have a positive spread. That's a great place to be. You want to be, buying a 10 cap rate property and borrowing at 5%. You want a nice big spread there. So every dollar that you borrow from the bank, over time, inflation will drive down the value of that loan in real dollar terms, right? Because the value of that loan, though it is also going down because you're paying it down, it is also losing buying power over time. Your asset is appreciating in value while your loan is actually adjusting for inflation. Your asset is appreciating over time. Maybe not right now, because high inflation times, to beat high inflation, they raise rates, which crush asset prices. So real estate in the short term will be painful, but over the long term will outpace inflation. So the good news is, guys, maybe real estate got ahead of inflation a little bit in the last 3 years. And we've seen a correction now, especially in Ontario, where we saw a 30% pullback in some markets around Toronto and London. And that was us catching up. I think it was a bit of a bubble. Things were a little inflated. Things have come back down to reality, especially as rates do eventually come back down. Not yet. It's not happening right now. Don't plan on it yet. But eventually it will come back down. And when it does, I think it's super important for us to have some exposure. The time that real estate, it won't rip right away, because comps take time I've talked about this ad nauseum on this channel, but I'll say it again. It takes time from the minute you decide to sell to when you actually get an offer, to when you actually close on said property. And so that takes a lot of time. And then the appraisers can start using that, and the realtors can start using that as a sold comparable, which will then dictate a new anchor price. And you have several of those on a street or in a neighborhood, then you get a new anchor price. So when markets are falling, it takes time for the effects of those falls to happen. When people are defaulting, it takes a year to get a full default judgment, right? So by the time that person stops paying their mortgage, it's almost a year before the house is sold and become a comparable. And as those houses hit the market, those defaults, they will, be. And then another issue I just want to bring up while I have you guys here is commercial real estate. We have $1 trillion in commercial debt that's coming due, that's at 3% and now is renewing. That's a problem because rates are now double what they were. And all these commercial buildings in LA, New York, Vancouver, Toronto, major cities, they don't cash flow at these higher rates. They're at huge losses. And so some people who bought their properties and have a great appreciation are like, you know what, sell it off. I don't want to hold the building. I have to refinance. My mortgage is now double. Forget that. I'm done. And a lot of these guys will just sell off. And so we'll see new inventory hitting the market, which is great for us to buy. At the same time, it could potentially lead to some opportunities, right? So if you're there to buy some of that, to take on some of that pain, and you can do a short-term variable product, or you have cash, or you can hold out until rates come back down, there's a real opportunity, I think, to buy where these guys are looking at renewing and they're like, wow, nothing cash flows. And so for a little while, you might have no cash flow, but you're looking at a great opportunity. So this can be a really great opportunity zone for those who are looking for it. Hang in there. If you're on a variable product right now, I think don't sell with the crowd. When the crowd is selling, you want to be buying. When the crowd is buying, that's typically when you start to sell. It's why I sold most of my portfolio off in 2021, end of 2021 into 2022, January. And I have no regrets on that. I took that cash and put it into crypto and lost a ton. But no, I timed real estate pretty well though, gotta say. Okay, next question was, okay, thank you guys, appreciate it. What's up? It says hello from Alberta with spring here. I'm looking to improve my home's landscaping and lawn to add value. Thank you for your recommendations. Definitely, the thing with landscaping though is it's great for Airbnb. You need to do that for your tenants, but if you're living in the property, landscaping fades after 2 or 3 years. You put wood chips down, they're garbage after 2 years. So something to think about. A lot of people will start in the landscaping. I start inside the house. I improve the house all the way. I start with the roof, of course, and then I work inside the house. I do the landscaping at the very end, or right before I'm going to sell or refinance. If I'm going to do Airbnb, right before I take my pictures, because the landscaping is fleeting. The weeds will, in 6 months of not caring for the landscaping, all of your work is kind of gone, right? So it's an investment that can have a great yield if you're going to sell or refinance, but just in general, keeping a really landscaped property, it doesn't actually give you a great yield. So I know some investors get just dump thousands of dollars into that, and it's not something I would waste money on. Unless, again, you're refinancing, taking pictures for an Airbnb listing, or again, selling. Eric says, where can we learn more about the wholesaling in GTA Mississauga? I got my realtor license and I just want to utilize it after watching your comeback videos. Yeah, so I think that a big piece of wholesaling is just knocking on a lot of doors and talking through and looking at a lot of opportunities, right? So it's important to think through, oh, an offer just came in. Cool. I don't know what that's about. I have to check the email later, but on a deal that we're working on, I'm excited about that one. I'll check that out after. But it's just, again, throwing out fishing lines. I'm continually throwing out offers in multiple directions, off market and on market. And I know a lot of wholesalers right now who are finding stuff on the MLS and negotiating, like on $1 million listing, negotiating like 190,000 off. I saw a beautiful waterfront cottage that sold for $200,000 under asking. It was like a $1.3 million property, something like that. And I was like, wow, 20% discount off the MLS. There isn't a wholesaler who's offering something of that good of value. So you can find stuff on the market right now that just isn't getting offers, that's maybe overpriced, where you can get in there and negotiate. And you might just think, oh, well, at list price, it makes no sense. List price sometimes has no relevant correlation at all to what it's actually worth. The seller might have an idea in their head and they tell their agent, or their agent might have an idea in their head, and together they come up with a price. And sometimes that price is wrong. And so you can go in there and show them comparables and say, here's my offer, here's what I want to pay, here's why. And sometimes they'll work with you. And so you can find offers and deals all over the place. It doesn't have to be off market, but you can even take stuff on market with an assignment clause and then go and sign it to someone. The idea of wholesaling is just getting something under contract, getting paper, and then selling it to someone. My greatest wholesale ever was a $400,000 assignment of one piece of paper. I mean, $400,000 on the sale of one contract. I had another one that was like $120,000 once. So it can be a great generator of cash if you can get a great deal. And in one of those cases, it was on market. I was able to sell that paper. So you'd be surprised what you can do with, having that piece of paper, having some, intrinsic and real value. People don't see that. So that's definitely something that you want to look for. When it comes to wholesaling, it really is just like a good wholesaler just has someone out there, a lot of bird dogs out there that are throwing out, knocking doors, looking on Marketplace, Craigslist, Kijiji, all those sites, and finds it, right? Like I know people who are able to find great deals who can't find investors for that deal, even though it's a great deal. And it's like, because they haven't built out a good buyer's list, right? So those are the two pieces to the wholesaling business. As a realtor, you say you're a realtor in the GTA, Greater Toronto Area, you're definitely gonna have to be careful about disclosures. You can't be taking Granny's house for 70 cents on the dollar without telling her that you're doing that. Disclosing, hey, I've showed you comparables and I'm offering you less because of X, Y, and Z. Now you can do that. It makes your negotiation harder as a realtor. I would say the better way to do it is to find someone who you can partner with or hire and have them, partnering with is better, have them be on a commission base or something like that, where they can lock up the contract and you as the realtor can help them find a buyer for it. Maybe you're partnered up 50-50 on the fee that you guys take. And honestly, when I started wholesaling, I just did base hits for like $5,000. I would just assign great properties for $3,000 to $5,000 and just quickly move them. I wasn't trying to be greedy, and I think that's the good way to make a brand in the space is like, you don't need to focus on short-term greed now. I see a lot of new rookies, like new young guys or whatever, going into the real estate space, and they're, like you said, trying to get in there and trying to just make a big quick buck. I think it's better to focus on the long term. And so that means sometimes you might give a deal away for $5,000. Even if there's $100,000 in profit on the table, I'm only take $5,000 as a fee because I know they're going to call me back next time. I know when the deal is successful, we're going to have a relationship that continues to build. And for me, that's better than trying to squeeze something once. I'd rather build a long-term relationship. And you know what, like 2 years, you might think nothing happens, but 2 years later, that person calls you and something falls in your lap because of it, and you get a huge 6-figure payout down the road. So I'm all about the long game, all about building relationships and nurturing that. And I think it's more important to go for the long game than go for the short game. That's me. It doesn't always yield you the most money, but it will make you feel better as a person and you'll have a great network in the long term. Don't be short-sighted, guys. Think for the long term. All right, Eric says, I don't know where to start and connect all the dots for the contract negotiation. So really, when talking about contracts, like if you're already a realtor, you know how to write an agreement of purchase and sale, right? There's actually like literally in your Matrix login, you'll see all your web forms. There's literally an assignment of purchase and sale. That's what a wholesale assignment is go look up that form. I think it's called a 120. It's 120 an amendment. I don't know. In Ontario, I think it's 120, but they have a name for the form. Just type in like amendment of purchase and sale, look for assignment of purchase and sale. I see a lot of people do it as an assignment. I've seen it done as an amendment too. But assignment is nice because as long as your original contract has the right to assign it or close it in any name or corporation you'd like, which the pitch is like, literally I have multiple corporations. I'm gonna go with a partner. We're gonna form a new corporation together to buy this property. Say, okay, of course you're gonna have a condition in there to do that. And then if you want to escape out of the deal, you put an escape clause for like 5 or 10 days to shop it around. You could say, pending partner approval. Super easy, and you can back out if the deal doesn't work out. These days it's possible, but for the last 3 years, it was really hard to get that condition in there. People wanted a firm cash offer. They wanted you not to be able to escape or back out. And so that's something that, sometimes I would go in cash, just knowing that like, if I can't find an assigner to take the deal and I can't assign it away, I'm going to close out myself in cash. And that's where you're okay. Where you're taking a contract with the sole intention to sell it to someone else, as a realtor, you can get in big trouble. Not allowed. So just be careful. Again, there's HST considerations. There are some licensing issues for a realtor doing that. It's a bit shady and shisty, so you got to be very, very careful. And a lot of these wholesalers do skirt lines. I've seen them, some of them will lie about things in the property. So you got to be very careful as a buyer that they don't have the same, fiduciary duty to the buyer. Whereas a realtor can't lie. They can't intentionally, some realtors do, but you shouldn't. And you get in trouble if you do, if you lie about things about the property or omit things to get a commission or get a deal done. So it's something to look out for, guys. Something to look out for. All right, next question. I'm scrolling down here. Port City says, we're living in a clown world. Yeah. The thing is, on one hand, they printed trillions around globally, multiple trillions of dollars through the pandemic, and then expected that all of that printed money wouldn't end up creating inflation. It's like, of course it's going to, and that's what it did. But the thing is, a lot of that money, or some of that money, is sitting on the sidelines. And so what you're seeing with these multiple offers is cash that was afraid, that's no longer afraid, that's seeing some sort of path forward that looks like it's going in the right direction, and that cash is going to get into the game and start buying some of that inventory, right? At the end of the day, a lot of these markets, specifically in Ontario, in Florida too, but really bad in Ontario, it's really hard to develop, to add more units. The municipalities make it really, really hard in Ontario. You're years out from when you get the dirt, shovel in the dirt to final finish. And so because there's so much red tape and so many fees and it's so hard and there's so much risk, people aren't building enough. They're not incentivizing that. They don't want that. So they've created a housing shortage. There aren't enough houses. And in Canada, we're taking in 500,000 immigrants every year, and most of them are coming to Ontario. And so when we're taking in hundreds of thousands of families and we're not building hundreds of thousands of units, we have a supply-demand imbalance. So it doesn't matter how high rates get, the immigrants will find a way to buy something. The locals will find a way to mortgage up to the hilt to get into the deal. They're not going to be, they're going to find a way. If they have the capital, they want to put it to work. They can only sit on the sidelines so long. So some of that cash is piling in right now. And I think maybe some of it ill-advised. For people who piled in last year, I feel so bad for some of the stories I hear. But they put 25% down. The market in Ontario ripped down because, again, we're so indebted in Ontario that the rates, when rates went from 2%, and we have 2 to 5 year fixed mortgages. We don't have 30-year fixed rate mortgages. That's a US thing. In Canada, for the most part, half of people are on variable, and the other half are on 1 to 5 year fixed terms for the most part. And so that means within a 2 year period of rates being high, something like 70 or 80% of all mortgages are affected. Whereas in the US, they aren't. People are locked in for 25 years. They feel nothing. Locked in at 4%, they don't care. 3%, they don't care. But in Ontario and in Canada, we definitely feel it in a different way. Because again, half of all rate mortgage holders in the last 3 years were variable rate mortgages. And then think about it, 20 to 25% of all fixed rate mortgages renew each and every year. And so if we had 2 years now of rates being higher, coming up into the second full year, we're looking at another 40% of the fixed rate mortgages being renewed. So all 3/4 of Canadians are feeling it right now in a way that they aren't feeling it in the US. And so that's why we felt more pain, is because, again, we're so sensitive to that. Over time, the longer rates stay higher, and they continue to stay high longer than most people expected. And I'm glad the Fed, they've come out and said, we don't know if we trust them, but Jerome Powell's come out and said, rate hikes, as in more than one is still coming. Even at the last meeting, he used that same language, hikes with an S, meaning more than one 25 basis point hike to come. Will he pivot? I don't know. Is he horrible at keeping his word? Yes. We've seen that the Fed has been horrible in the last couple of decades. And so we've lost confidence. And I think the bond market's lost confidence in the Fed's, ability to deliver what they say. And so I think, it's just my opinion, this is my hunch, but I think that Jerome's sick of the bond markets not taking him seriously, and he's going to deliver us pain until Congress comes in and stimulates. And then Congress is going to come in, because all the people are screaming in pain, they're going to relieve, they're going to stimulate. And when they stimulate, they make Jerome's job even harder. They make the Fed's job harder, because when you print money and you hand it out, you create inflation. And so he needs to keep rates higher, or higher for longer. If he doesn't make them higher, he just has to keep them higher for longer. And so there's more pain. And so it's just a vicious cycle. What we saw with the banking crisis only, solidified in my mind the opinion or the thought that rates are going to stay higher for longer. So I don't think they're going to pivot soon. If they do, I think the fall, if they could pivot. And if they do, if there's a lot of pressure on, the Fed committee and they decide to, pivot early, that will result in another wave of inflation. And it will be just like what happened in the 70s and 80s. There was an 11-year period of zero appreciation in real estate. In terms of real price, real estate didn't hold up over a decade. It happened again from 1990 for a decade and a half till 2005. In Canada, we had another 15-year cycle where there was, again, no real appreciation in real estate. That can happen again. That's happened multiple times in the business cycle. And people in the last 20 years have forgotten that you can have years where you buy a house and 10 years later it's worth the same amount of money. There is no appreciation that takes your house from 200 to 600, which is what happened in the last 5-10 years. And people are not long-term focused. And they've had many times where there's been a challenge with keeping inflation under control, and it goes like this. And so it might seem like a trend right now, but we may have another uptick. So it's hard to predict how things are going to go. I wouldn't want to bet on everything going back down. Again, I try to hedge both ways. So I have some investments that do really, really well, and I have a lot of investments that will do really, really well in the other scenario, which is where, rates come right down and it's great. Like my real estate business would boom. But then I have a stock account I'm shorting, right? So I can try to win either way. And that's what you want to do, is set yourself up so that you've protected your downside and that you try to win in both markets, in both environments. And that's what we do as investors, is try to hedge our risk and continue to move forward. You want to have like 90% of your fortress of solitude, your portfolio of investment in safe things, and you take 10% and you put it in the win shots and the 10Xers, right? Okay, next question. Thank you for hosting. Grinder says, are you going to still buy properties in Ontario or just stick to Florida for now? I'm still buying in Ontario. One of the challenges I have with the US market right now, there are a number of challenges. I can make a whole video on some of the things I've learned that are worse in the US than in Canada. And a lot of investors right now are saying how great Florida is. And it is amazing, by the way. There's a lot of great things about it. But cost of insurance is super high in Florida. There's always the risk of, hurricanes and things like that, which is, a pretty decent risk. There's also the fact that they have local state taxes and licensing regulations that are a pain in the ass. Their federal tax rates are like 28%. It's pretty brutal. There are some things that aren't so great about the US. Their lender fees, all their lenders charge like 2% lender fees, whereas in Ontario and in Canada, there's no lender fees. A bank puts up a mortgage, they will even comp you the appraisal fee. You pay nothing. Your mortgage was 1.5%. That was all you pay. There was no setup fees. It's brutal in the US. Again, their mortgages are for longer terms, so that's why they can get away with those large upfront fees. But for someone like me who might churn my real estate more often, it's not as advantageous. And then there's some interesting discharge fees when you put a mortgage on. There's taxes in Florida on that mortgage amount, which is weird. That's something that's just not a thing in Canada. A lot of things I've uncovered along the way. In general, the Florida market is 10x bigger. So there's 100 times more opportunity. And I like that. There's way more deals to hunt for, and there's just a better capital market. So there are reasons why I love Florida and will continue to invest in Florida and the Bahamas for tax reasons. And I like the triangle between Canada, Bahamas, and Florida. I think that triangle makes a lot of sense. It's a great lifestyle. It's tax optimized. There is a great reason why I want to invest in all three of those places. Canada has some really challenging landlord rules, right? So Canada's great in a lot of ways, but it also has a lot of shortcomings. And again, those shortcomings are like, I wouldn't do a long-term rental in Ontario. I just wouldn't. Alberta, Canada, I would. It's like Florida. You can raise the rents on tenants, you can evict them fairly easily. Ontario, it's like California. Good luck, right? The province that has the most growth potential, I think, is really Ontario, because those supply-demand imbalances and how hard it is for people to add units and to build and to develop. And so on one hand, I think the appreciation might be a little bit stronger in Ontario than, say, Alberta. And again, it's more of a balanced market in the sense that all the sectors that bring GDP growth for that province, they're very natural resource strong in Alberta, whereas Ontario isn't reliant on, say, oil or natural resources near as much. So that's I like Alberta. I'll probably be investing a little bit more in Alberta. I like that the corporate tax rates are much, much better. I like that you have power as a landlord to actually raise rent to keep up with inflation, or even more than inflation if you wanted to, that's powerful, I think. So yeah, no problem. Happy to host. Default says, what would you recommend for someone with $250,000 available? Default, it's so hard for me to say, hey, like this is the one thing you should do. I would need to understand you as a person and understand your risk profile. When I used to be a financial planner, I was licensed to sell mutual funds and insurance and all of that. So I lived that for a while, being a financial planner. I love that. I still think that someday I'm going to invest in a business that helps people with financial planning in some way, like a robo-advising type business. If anyone knows of any opportunities, I'd love to invest in something like that. Hit me up. But anyway, that's just a sidebar. But again, talking back to your question about how you might invest that $250,000. If you're looking for passive income, let's say you need that stable income, you can take $250,000, lend it out in maybe a little bit riskier but secured private mortgages, and you could fund a mortgage on some, say you find a $400,000 property, you put the $250,000 mortgage up, that investor puts $150,000 down, they cover the renovation, you've got some safety there. If the property falls in value, you don't lose a dollar until it has fallen like 40% in value. So that you're pretty safe that way, and you can make a 10 or 12% return, which is like $2,000 a month on $250,000. So there's 25 grand a year passive income, like literally passive income on $250,000. But if you told me, hey, I don't care about passive income, I already have a job, I already have a source of income, what I need is to grow that aggressively, and I'm okay to take a little bit of risk. And if it fluctuates, 20, 30% in a given month, I'm okay with that. I don't need that money right now. I would take you on a real estate growth strategy. We would start flipping, we would start burring, we would start growing that from 1 property to 2 to 4. It would be a lot of work if you have the time to put in. If you came back to me and said, like, there's so many pathways I could tell you to go, right? If you came back to me and said, hey, I have no time to be renovating properties, managing contractors, fighting, negotiating, all the crappy stuff about running a real estate business. Like, I don't really like that. I don't want to fight with tenants. I don't want to deal with all that drama in my life. I don't want those 2 a.m. calls. They're okay. Let's have a different path. Maybe there's another passive income path. And how are we going to break this asset class out to generate maximum growth? And so I might take 10% and put it in cryptocurrencies at the next dip. And I might take 50% of it and put it in the S&P 500 for you and build a dividend portfolio. And we might buy a rental property with 100,000 of it. It might be used as a down payment to buy something passive, put a property manager in, and done. Now you can create a portfolio that'll generate you, at least a 10% yield fairly safely. And so it depends on your risk profile. I can't tell you there's one way that's the best way. It depends how much time you want to put in. If you want to put no time in, or you're not skilled and you're like, hey, if I get into renovation, I know I'm going to mess it up. I'm going to get in like a big issue and I'm going to lose money. It's like, okay, if that's the kind of person you are and you're not going to put the time in, you may lose money. If you don't put the time in real estate investing and you're going to go in there and manage it yourself, you're going to go in there and renovate, and you don't know what you're doing, you can lose money. There's a risk there. I think with real estate investing, you can insulate yourself against those risks, again, because you're putting your time and your effort. If you do it right, you analyze the numbers right, you have an insulation there that protects you against market volatility. So for me, real estate, I'm biased, but there's many other businesses you can invest in that can also generate great cash flow. I know people who do the FBA, they do like the Amazon reselling stuff. I know people that do YouTube automation and stuff like that. There's lots of ways to make money. I've found YouTube is not a moneymaker, but that's because I don't treat it like one. I get on here with no preparation and I just tell you guys how it is. I should have a whole ecosystem brand around this. Like, I have 30,000 subscribers and I get thousands of story views on Instagram and I monetize none of it, right? Like, once in a while I'll do a coaching calls with people and charge $800 for, a 40-minute coaching call, and people will pay that. So I know that my value is there and I could guide someone. I've done coaching calls where the fruits of those calls led to someone making a different decision in their real estate portfolio. Over a year of talking to them, they made $100,000. So that ROI for them, talking with me for those couple hours strategically, revolutionized the way that they were doing their flipping business. And so I know that I could have a business around that where, like, if I found someone who was like me 5 years ago, still hungry, wanted to grind it, you could build a really cool business around this. Like, I've got this idea, and I'll share it eventually when I'm ready, but there's really could be a cool mastermind, online mentorship program that's coming. I'm going to launch that. It's going to happen. I just need a good running partner because I'm so busy. I have 3 kids and like 5 businesses on the go, and I enjoy my free time too. So if I added another business to the mix, one of my other businesses has to give. Like, I have to stop flipping as much, or I have to stop. And my flipping business is a family business. Like, right now, it supports my dad full time, it supports my brother full time. They work in these businesses. And so for me, it's like I have people, like my best friend also works in that same thing full time. So if I were to slow that business down, there would be emotional sacrifices there. to slowing those businesses down. And I love trading as an example. That's a thing that could free up. I probably trade 3 hours a day right now. I could do less of that, but I enjoy it. I like it. And I like it more than being on a coaching call. So it's tough, right? When money's important. It's a yardstick to measure success, and it's great. But at the same time, it really is. I'm not as hungry as I used to be. So if I find someone that wanted to grind, I would love to come on once a week and run a mastermind and do like what I do here, live Q&A, but with specific situations where maybe I'm partnered up on some of these deals. It could be a really cool ecosystem. So it's something that's on my vision board, something I want to do. I just haven't committed the time to it. And it's like, where do I get the time from? Well, I need to partner with someone, and I'd be okay to give away a percentage of my equity stake in that business if I had a running mate who really understood, like had a successful real estate business already has 10, 20 properties, already has a couple million, has done this, understands it. We can come together and build a really cool course or mastermind and deliver real value for people. Because there is that gap in the marketplace right now where there's a lot of people selling a lot of courses that aren't good and they aren't focused on the success of the individual. So there is a huge business that can be there in the financial planning space too. I'd love a business where I could help coach people, and it doesn't have to be a lot of money. Like you could have a lot of students that paid 10 or 20 bucks a month, or even a percentage of what they're saving. Like, hey, before joining the program, how much from now are you saving? It's like giving a percentage of that. And then you're still aligned with their goal of trying to master frugality and starting to save and invest. And it's just those little steps, like people just started making little conscious steps now, could just be so impactful and so powerful 10, 20 years from now. The little decisions you make now have such big impacts later. And it's like, we always think we could do more in a year than we actually can. But over a 10-year period, we can do way more than we thought we could. All right. I wonder what your view is on the recession in the housing market. Prices dropping in Ontario. I just don't think it's going to happen. Found out 3 people on my office project are renovating their homes. Again, just to comment on your question there, we've already had a big recession, 29% drop in real estate prices in most markets within Ontario. So that was substantial. If you bought a property in the last 18 months, your down payment is gone. You have nothing in the property. The bank owns more of the property than you do. Almost all the properties are underwater. In fact, the big 5 banks in Canada went to the government last year and was like, hey, people can't afford to pay. We have a problem here. And said, okay, can we extend amortization to 40 and 50 year? And can we make it so that all the banks are doing this right now, by the way, for all the variable rate products, anything that is jacked up in price. Hey, can we instead do even less than interest only? Can we have them pay 0 principal and amortize this out for 50, 60 years? Are the ways we can change things? And they went and they had a constructive decision. They came back basically that they were able to freeze things. So a lot of Canadians aren't feeling as much as they could. It's dangerous right now. The banks are on thin ice, and I think that there is a tail risk that the banks could need government bailout. They could have huge write-offs and losses. Could be really dirty in Ontario. So it could get worse. I think more likely than not, the 30% pullback we've seen was healthy, and I think we're going to continue to trend flat. And I think we'll probably see it. To me, it feels a lot like when I look at the data and I look at what was happening in the early 90s, it feels a lot like Ontario in the early 90s. And you bought a house in 1992. By 2005, that house was worth the same amount of money in Toronto. In Toronto, over a 13-year period, you made nothing. Adjusted for inflation, you actually lost a tiny bit. So that's a reality. Some people think they made money, but they weren't factoring in inflation. I think that same thing is going to happen in this next 5-year stretch, potentially in Ontario. So we may not see that huge rip up, but a stable environment. I think we're going to be more stable now, maybe slightly down, but it's not going to be an aggressive pain, right? The aggressive pain happens when the Fed goes from 1% rates to 5% rates, like a 400% hockey stick up. That's painful. We're not going to see that same amount of pain. Most of the tightening is done. Now it's like with braces, we just have little adjustments. And hopefully we can navigate back down to a reasonable inflation. So I think it's a great time to start doing business in real estate. It's probably not the bottom yet. We'll probably still shift a little further down into this December. I bet you we'll be lower than we are now. That's my presumption, it's my guess. It could be even worse in the years following. In 2008 to end of 2011 before real estate found its bottom. It took 3.5 years. Rates actually went back down to 2% in 2009, and still didn't stimulate the real estate market until 2011, end of 2011. It took for the national prices to start coming up. So I think we have the big commercial debt recycle coming out this year. and into next year where a lot of the mortgages are renewing in the US and in Canada and globally. And they were at 3%, and now they have to come back at 6%. And that's a real problem. That could be a collapse, potentially for the banking sector. They might have huge losses. And they have to work with the mortgage holders because they can't just raise rates as much as they want if the guys can't pay it. So there may be some opportunities here. I don't see a big rip up. So I don't see any jump up and I don't see any jump down. A lot of real estate investors are like, oh, big appreciation is coming. It's not coming. We're not getting a massive 10 or 15% appreciation. If you're like, oh my God, I'm so FOMO, I'm afraid of missing out, I gotta get in to buy a property right now, relax. We're not going to see 10 or 15% appreciation again for a while. And we're probably not gonna see another 10 or 15% drop for a while. We're probably gonna float sort of flat for the next little while. And inflation will continue to run a little bit higher than I think what the Fed wants and what we would want. We want inflation at 1.5%, 2% because we want to preserve the dollars that we have. So we don't want inflation to run high. The government actually does. They say they don't, but they actually do. If they let it run high, and if they were ever to admit that they want inflation to be higher, that would be a real problem, right? It'd be a global collapse. No one could do business if they think that inflation is going to run high. So everyone has to believe that inflation is going to come back down. And it's important for an economy to function at a reasonable inflation rate, right? So I think we'll get there. I hope we get there. My thoughts are that's going to lead to, when I think that through, it's going to lead to probably a flat market for some time. So that's my advice. That's where I think things are going to be in Ontario. Probably similar in Florida. We can see a little bit of a pullback, but we're not going to see a big collapse, I don't think, in the same way that we saw it before. You need a big event for that to happen. And I think probably over the next 5 or 10 years, we'll see a strengthening in the Brazil, Russia, China partnership, and there's many other countries jumping on board in South America and all around, and especially in the Middle East that are going to jump on board with this. And I think we'll see China grow as more of a global power, especially India as well, growing as a global power, and the U.S. slowly losing some strength. And that may result in some economic tension. Could be an economic war, could be a real proxy war. That's a real risk here as well, guys. So I think that there's a lot of downside potential, not a lot of big upside rip happening in the next short term in real estate. Probably more likely than not, relatively flat, which is great for flippers. It's great for us guys who buy under market and bring the property back up, renovate it, improve it. Because again, that's where we make our money. It's like if the market's flat, I can make lots of money. I know a lot of investors are like, oh, I just want appreciation. That's because they're not good investors. A good investor doesn't need appreciation. A good investor is buying a deal that's worth $1 million for $750,000. They're putting $100,000 into it, and it's worth $1.1 million. That's a good investor, right? And scale that to whatever you want. $100,000 houses if you want. The math works out the same. But that's what you have to be doing, is buying smart. And people aren't generally buying smart. So buy smarter, guys. I know people watching here are buying smart. So that's why we have this channel, right? Help you guys buy smarter, to be smarter, to look at the 1% rule properties, to look for, where other people are afraid, where you're going to get in there and add value. Favorite color to paint a rental? I like a warm gray like this. I don't know if you can kind of see this gray here. It's pretty decent. I like a warm gray. I like a lazy gray. Sometimes you want a little darker for an accent wall. I stay in the warm gray tones, but every house is different. Sometimes a house will call for like an alabaster white, which is like a sort of an off-white. It's a really nice color. You can use art to bring out certain colors you might want. I like to stay in the gray tones. I like to stay on the more modern side, but it depends on the house. Some houses, we keep things in the creams because, again, it's maybe got a lot of stone, a lot of, castle-y vibes, maybe some wood, natural wood knit. So it depends on the house. Hard to say there's one, but by and large, I have like 4 gray tone paints that I use on most of my flip projects and most of my renovation projects and most of my rentals. And I have that color palette that I stick to. Typically, you can go search in like the top 10 gray tones builders are using. Top 10 Benjamin Moore, top 10 Sherwin-Williams. You can look and see top 10 Dulux paints and pick the best ones. You can see the top 10 paints that designers are using. Use those. There's a reason that every designer is using said color. You want to be on trend, right? And so don't pick 10 years ago colors. Don't pick colors you like. It's about picking colors that work. Large renovations, that's great. Hey, how you doing, brother? Hired a waterproofing company 2 years ago to dig up side of house. I missed that. See, you're still here. Yeah, still here. Got a couple projects I'm trying to wrap up here, and then I'm going to be making my way back to Canada. I'll probably be back again in a little bit to check on things, but I miss home. I miss some of the projects at home. I've been putting a lot of things off since December back in Canada, and so it's time to get back there and check on some projects there. I'm thankful I have really great people. If any of the people that are a part of my Canadian team are watching this right now, I appreciate you so much. You guys know who you are, and girls know who you are, from bookkeeper to contractors, people who are keeping everything going. Appreciate you, because I haven't been home in 4 months and the business continues to run. Thank you. Stickman says, I hired a waterproofing company 2 years ago to dig up the side of the house to clear weeping tiles. This was to fix an issue of water coming in. Can I use them? They deny any wrongdoing. Well, most companies will deny any wrongdoing. That's just how people are when they don't want to pay. It's very difficult to waterproof in general. Yeah, I mean, if they did a waterproofing product they put the blue skin with the Delta on the side of the house? If they did that, it should come with a warranty. If they just did the weeping tile and they didn't do any waterproofing against the house, maybe not. Most of the time, like 80% of water leaks that I see in Ontario, maybe 90%, are to do with grading. Take all your downspouts, make sure your eaves troughs are all working properly, make sure they're all cleared out, make sure the downspouts are adequately sized, and put extenders on the end of all of your downspouts 6 to 8 feet away from your foundation. And then take grade and have your foundation of your house here, instead of having dirt like this, build your dirt up like that, and then put crushed rock. And what you'll do is you'll create basically a wicking of water away, create a channel away from your house. And that will just solve most of your problems. Even if you had, like I had once someone I helped, I came out to give them advice. They had a hole like that in their foundation, and they just patched it with concrete. They were too cheap. Their budget was blown. They couldn't afford to do a full $20,000 dig out. And I was like, I think if you fix the grade, they had a grading problem. Like their grade was like this in the yard, and all the water was on a big rain. I was like, let's take a hose. Let me show you what happens. And we sprayed it, and all the water was pooling against the house. I'm like, that's your problem. There is also the foundation hole problem, but like you could probably just patch that hole, fix the grading, and never have another issue again, have a dry basement. And that was the case. It actually worked. They were able to solve all their problems. More often than not, it's like a bad window well or a bad grading issue. Super easy, cheap fixes most of the time. Not always, but most of the time. Next one was, some reports are suggesting that there will be pain in the markets around June, July. Curious to hear your thoughts on that. I've seen some reports that are bearish, some reports that are bullish. I'm still bearish. Remember, the NASDAQ is up like 18% on the year to date. Crypto is up 90%. Some of the growth stocks are up 80, 90%. I think the market is too optimistic. And when the market's overbought, I want to sell. So right now I'm keeping, today actually I went long. I bought the whole market today. But I will dispose of that in the next couple of days, because my short-term thesis is that we're going to pull back. Even in a bull market, if you have a 20% growth quarter, which is what we had from December in the NASDAQ, from December to March 31st, we had 21% growth. On the index, specific companies, some of them are up 100%, like Tesla, Meta, all the tech stocks, right? Like Apple, everything was all the crypto, everything was just ripping up. I think that was too much, too soon, too fast. And even in a bull market, we should see a pullback. So I think given the turbulent times, when the Fed drops the hammer, they're going to drop the hammer, I think, in either May or in the summer. And I think that the market's going to go, oh shit, rates aren't coming down yet. They're going to pause. They're going to keep rates higher. And they'll start to see the ramifications of keeping rates higher, because the pain will start to set in if they stay high for long. And they keep going higher. And so when they stay at this height, there's going to be a lot of pain. And so my thoughts on it are that there is potential for a lot of pain. I would probably, buy some puts for July. They're probably pretty cheap on the next really big up day. So the next day is like a 2%. The NASDAQ's up 1 or 2% on the day. You see a really green day. Go out there and buy some puts. Take a couple $1,000s and buy some cheap out of the money puts. And then if we have a few bad days, those will probably do 1,000% return. If not, you have some insurance on your portfolio. Chuck it up to that couple $1,000s with insurance in case things go bad. And you can afford to stay long in the market while having that black swan insurance. So I have black swan insurance on. In fact, I'm even shorting most days. Today I'm long, but the next up day I'm going to switch to short again. I think there's more correction pain. I really do. And then the follow-up question was, curious if there's a mortgage renewal coming up for big apartment buildings that will screw current owners who are in the red. Yep, 100% that's coming. A lot of commercial mortgages are coming up for renewal. And then said, why would you buy smaller units and not focus on being liquid for when the time comes to buy more apartment buildings? So again, for me, I run a business where I'm buying stuff at, like this as an example, for $329. that's worth, well, it was worth 525. The market's pulled back a little bit here as rates have continued to rise, so maybe high 400s. I've got a huge margin. So the reason I park my money here is because my money grows being parked here. And if at any time I want to sell this for $475,000, I can. It's a 5-bedroom, 3,000 square foot, beautiful house with a big pool and a great area. Someone could buy this off us. Everything I have is always for sale, right? If someone wants a really turnkey, fully staged, really nice Airbnb, that's what this is. And so this asset is a place to park capital where we continue to grow it. And when the opportunity comes, if I found an amazing big deal, which I'm sure I will in the next couple of years here in Florida, I'll find a hotel that I really like. And when we buy it, we'll just sell a few of these, right? No big deal. I'll just sell these properties off for more than I bought them for. Even if the market declines further, I'll still make a profit. And then we can reallocate that capital. It's not that long for me to get liquid, again, because I'm in the business. So for me to sell a property is a couple months, right? When it's already set up like this, I could have this listed and sold in under 2 months, right? When it's all set up. The renovation process is usually a few months. You're talking like 6-month time window with a flip. If it's already flipped and you're holding it and cash flowing it, you can get into cash within a couple months. So for me, it's like if I see the right opportunity, most of these commercial buildings have 90-day closings. 4-month closings is not unheard of, right? You got 60 days of due diligence. And during that due diligence period, before you firmed up, you go lock up that great apartment building you're talking about or that hotel. And that's when we start selling other assets to get the cash together. Not a problem, right? So that's why, because I run a business and my real estate business produces cash flow, even in a flat market. Even if I think things are gonna go down a little further, I rebalance often. I don't look at like, and I could hold this house. I may end up holding this house for 20 years, who knows? I may not end up selling it at all, but if I need the cash, I can. And so that's how I operate my business. I'd rather not stay on cash. Being in cash, trapped in the banks right now, super dangerous, super safe here, generating a strong yield. This is what I want. I want to own a building that's solid, that's producing cash flow. And if I find a better building, I sell and I reallocate and rebalance. No big deal. It's like saying, like, why would you buy X stock when you might think there's gonna be a deal on other stock, right? It's like, well, you can just sell that stock and buy something else. For me, I'm able to buy stock that's worth X at a discount. And so that's a superhuman power that I can't ignore. Do you have $1 million? Yeah. Most people who follow me know that I've done fairly well in the last decade in real estate. My first deal in early 2012, I've come a long way. It's now been 11 years and I've had a lot of success. I rode a really strong bull market, but I operated well in that bull market. And I've had my challenges, my struggles too, and trying to grow the business and having 3 kids and all the other things that the world has thrown at me. I had sickness for a while. I have epilepsy, actually. People don't know I have some things that, like, you can have health issues and that can be a crutch for you. Or you can have, like I had a kid at 23. It's like a lot of people like, oh, they come out of school and they start having, like they have a kid and it throws your life off balance. It's like, I just made it work. I still had a real estate portfolio while I stayed at home with my daughter, my firstborn daughter. I have 3 now, but my firstborn daughter, I was an at-home dad while I was working full-time with my stuff. My wife went to work for a bit because we had to make ends meet. I was renovating 4 properties. I remember this is just after I retired. So it was like 2016, you have my notice, 2017, early 2017, I was with my daughter at home and she was like a year old. And we were struggling. We had like 4 or 5 renovations that would have went over budget. I ran into some issues. A contractor blackmailed us. They called the city on us. We had like a big minor variance I had to go through, and then all these permits, and I ran out of capital. Didn't have enough cash. I was deployed in all these projects. I had like 11, 12 properties, and I was deployed, and I had some issues where we didn't have the cash. So my wife stayed and went back for her. She had to get her maternity. She was gonna lose her maternity leave if she didn't go back for 3 months. So she went back for 3 months. I was at home with a kid doing 11 renovation projects and all the other things that I had going on. And it's like, I don't want to hear excuses. People are coming out with excuses. I can't do this. I can't do that. It's like, how can you do this? How can you get the opportunity to be able to own a property? How can you find a way to get through this? And it's like, that's the right question to be asking. Like, the opportunity to have this. Don't complain that you have these problems. No one cares. Most people are glad you have them, right? Like 90% of people don't care. The other 10% are glad you have them, right? Like, it's just focus on the positive. I get the opportunity to wake up and focus on 5 renovations at once with my daughter. That's amazing. I get to have my daughter around all day. Even now, my 3 kids are with me everywhere I go. I go look at a property, I bring them with. They might go drive to the beach with my wife, but everywhere I go, my kids go with me. Like I'm literally with my kids like 20 hours a day. They're over at the rental property right now because I'm doing the live stream right now, but like they'll be back in a minute, and I'm with them all the time. That's the life I like. That's the life I built it around. And so a lot of people have excuses. I say, look for the opportunity, find a way to make it happen. Yeah. Next question was, I just wanted to ask, what do you think about this property? I'm thinking of getting my first rental property. I don't know, you didn't send a link, so I can't tell what property you're talking about, but I'd have to look at it. It's hard for me to tell right off the bat, but I'm sure that if it's cash flow positive 1% rule, you can't go wrong. 1% rule meaning if the property is $300,000 to buy, you can rent it for $3,000 a month. That's what you want to be at. That's the rough ballpark. There's obviously a bigger due diligence than that, but that's like a first level screen. Curious your thoughts on dividend paying, participating whole life insurance. So let's talk about whole life insurance for a second. For most people, whole life's a bad investment. I'll just start with that. Like 90% of people shouldn't have whole life. They should have term and invest the difference. But sometimes net of fees, the tax savings of investing tax-free inside of a whole life policy can make a lot of sense. I self-insure. I have no need to protect my income, so I don't need insurance. I can use insurance as an investment vehicle, and I can borrow against the cash value, which is not what you're putting into the policy. It's what is net into the cash value, because there's a lot of fees. They eat a lot of your premiums to the agents, to the insurance company, et cetera, so forth. So net of fees, is the tax savings worth it? That's the analysis you have to do. Most of the time it isn't. If you're in the top tax bracket, it can be. For me, I'm gonna leave the Bahamas. So it doesn't make a lot of sense because I'm not gonna pay any tax anyway. And a lot of investors I know with the 1031 exchange in the US are able to defer tax indefinitely anyway. So they just roll the deal onto the next one and they're able to create enough write-offs from renovating the properties that they do have, they haven't sold, that they keep operating and operating break even or almost no profit. So tax is zero in many cases. So when you look at like there are opportunities out there to grow almost tax-free, it's like, well, why would I invest in an insurance product with a 5% yield when I can get 20% or 10% or 15 or 30% yield, whatever, in real estate actively? Why would I get a 5% yield here and then pay fees? It's not a 5% yield. If you add up all your premiums, which you're actually paying in premiums in these whole life policies, universal life policies, a lot of it goes to fees, especially in year 1 and 2. And so the drag on all of those fees compounded over 50 years is millions of dollars. If you just taken that same amount of money you would have put into premiums and invested it in a tax-free savings account or into a real estate property over 30 years, right? So it can make sense in really high tax jurisdictions sometimes. It does make sense if you're an insurance agent, you go get your license, it's really easy to get. In like a month, you can get your own insurance license. And then you can go to a company and their intro bonus, if you sell a policy, you get like 90% of the first year's premiums as a bonus and commission back. Now you write yourself your own $1 million whole life policy and get that kickback. That can make sense. Now that can make sense because that 90% in your first year, that first year's premiums, which in some cases on these huge policies is like 100 grand. That amount of money back, you reinvest that too, and then you lever the policy up, you borrow 90% of the cash value back, you have almost no money in this policy. The leverage, if the cost of debt is lower than the yield of the policy, right now it doesn't make sense. But when yields were 2%, you could borrow against these policies at 2 and 3% from third-party banks, and your cash value in these policies was generating a 6% yield pretty safely. That made a lot of sense. Now we're borrowing at 7% against these policies that are yielding 6%. Not such a good spread. It will become a good spread again. And if you're going to stay in Canada, it makes sense. If you're rich, you're going to stay in Canada for the long term, it's a great estate planning tool. It can be a great tax vehicle. Most people it doesn't make sense for. There is a niche that it makes sense for. The math sometimes works out really well. So do your numbers. It's hard for me to say like insurance is great or this is great. It's like in certain situations, X is great. That's my thought on it. Denny says, how do you structure investments from a tax viewpoint in the US? Could it all go into LLC? If so, under LLC, under Corp? So the right way to do it is different for each person. But one way that tends to work well for Canadians on the 4 calls I've had now with accountants that are cross-border specialists, the common theme was protecting yourself from liability means you need several layers of protection. You could just go buy a property in your personal name as a Canadian in the US and you have no double taxation because you would get recognized for all the tax you paid in the US as a credit in Canada. So that's a decent setup. But you're not protected for liability at all. Financing can become a nightmare once you buy more than one property. But that's a place to start. If you take away liability and just focus on tax, you could in theory set up a Bahamas IBC that is basically a Bahamas Corp that has no capital gains tax, no tax of any kind, and it could own a Florida LLC. And you could buy property and own it from the Bahamas or some other nation and be almost tax-free. And from the Bahamas, you can 1031 exchange. So your corp in the Bahamas, though being a Canadian owning this Bahamas Corp, you could in theory 1031 exchange. So that's cool. You can also set up a corporate structure that can 1031 exchange. The problem is the Canadian government does not recognize said structures 1031 exchange. So when you go to sell said property, the US might say, hey, you get the deferral on the capital gain onto the next property, but Canada's going to say, hey, pay up 26% tax. And so that's where you're going to have some problems. So you want to set up a structure that works for that. It's really difficult as a Canadian investing in the US for that purpose. All right, guys, I had to go. My kids are back home. Thank you, everyone, for watching tonight. Remember, the secret to unlocking wealth for you: spend less, earn more, maximize returns of the difference. I'm coming, girls. Bye, guys. See you next week.